Good evening and welcome to tonight's market analysis. Today's U.S. equity market delivered a structurally driven rebound led by technology giants, but it was far from a broad-based rally. The Nasdaq Composite surged, with the QQQ ETF gaining 1.78%, while the S&P 500 rose a more modest 0.66%. The Dow Jones Industrial Average lagged behind, and here is the critical signal that demands attention. The VIX Volatility Index actually climbed 2.53% to close at 17.01. That is a red flag waving beneath the surface of today's gains. Now let us focus on the single most important driver of today's session, the 10-year Treasury yield. It fell sharply by 1.43% to 4.49%. That move directly ignited buying in large-cap technology stocks, the most sensitive to interest rate changes. Money flowed out of gold and Bitcoin and poured into the Nasdaq 100 giants. Spot gold slipped 0.69% to $4,503.60 an ounce. Bitcoin dropped 1.74% to $75,754.69. Crude oil bucked the trend, rising 1.75% to $93.60 a barrel, supported by ongoing geopolitical risk and supply concerns. The character of today's market is very clear. This is not a broad-based improvement in risk appetite. It is a highly concentrated rotation driven by interest rate expectations. The bond market led, equities followed, and currencies remained neutral, with the dollar index holding near 99.14. What makes this session unusual is the divergence between the equity rally and the VIX. Normally when stocks rise, volatility falls. Today it rose. That tells us there is deep internal disagreement about the sustainability of this move. A significant amount of hedging is being put on even as buyers push prices higher. The bulls are strong enough to absorb that selling pressure, but the foundation is fragile. Looking at the global sequence, the Asian session was largely neutral, and European markets were calm. The real action started when U.S. markets opened. The drop in the 10-year yield triggered immediate buying in tech stocks, with QQQ and Tesla opening higher and staying strong throughout the day. But the VIX crept higher as the session progressed, indicating that defensive positioning never stopped. The SPY underperformed QQQ by a wide margin, confirming the extreme concentration of today's rally. For tomorrow, there are several key levels to watch. First and most important, the 10-year yield must hold above 4.5%. That is the lifeline for the tech bull case. If it bounces back above 4.52%, the entire tech rally narrative comes under threat. Bitcoin near $75,000 may present a short-term oversold bounce opportunity, but the probability is only 55%, so caution is warranted. For Asian markets, we expect China's Chi-Next index to open higher on the positive sentiment from U.S. tech, but limited domestic volume and structural issues may cause it to drift lower into a range-bound session. In conclusion, today's market delivered a clear message: capital is rotating out of safe haven assets and high-beta speculative plays and into large-cap technology stocks. The sustainability of this rotation depends entirely on the bond market. As long as the 10-year yield stays below 4.5%, the tech long thesis remains intact. But the VIX warning cannot be ignored. Tomorrow's focus should not be on whether the market goes up or down, but on whether tech strength can persist and broaden out to other sectors. Stay disciplined, manage your risk, and watch the yield curve closely.